This stock investing strategy returned over 20% annualized gain for 36 years. That turned $10,000 into over $7 million, and it only used one key metric. Hi, I'm John from ValueGlance.com. I have a PhD in theoretical physics. I've worked as a financial research analyst on an 11-figure fund, and I'm the author of the book Stop Checking the Price. We explore strategies to find high-quality stocks that win the long game. Today, we're going to be talking about the value creation yield, what it is, how it's powerful, and how we can use it to actually beat the market over the long term with great results. All right, so what is the value creation yield? Well, it's a metric that combines two key metrics that we've used in the past. We see it's the ROIC divided by the hype factor. And so we take that ratio to get this number. It's a yield. It's in the form of a percentage, but we can break it down a little bit further. And so remember, ROIC is telling us if we have our business here represented by a box, that business takes in invested capital, IC. That's debt and equity. So shareholders and debt holders provide that capital into the money-making machine so that that business can then produce profits. So out of the other side, we have profits. In particular, the NOPAT, the net operating profit after tax, but we could just think of that as profits. And so ROIC then is the ratio here of the NOPAT, the profits, NOPAT divided by the IC, and in particular, the book value of the IC. So what the accountants say on the books is that equity and debt contribution. What about the hype factor? So the hype factor is a multiple. It's the multiple that the market is willing to pay for that invested capital relative to the book value. So we can call that the market IC divided by the book IC. And so if we put these two together, what we realize is the value creation yield, we could call that just VY, is equal to the NOPAT, so profits, yearly profits, over the market IC. And so this is why the metric is powerful. It combines these two key metrics. On the one hand, we have the quality metric, the ROIC, key quality metric telling us how well that business is turning capital into profits. That's our quality metric. The hype factor is the valuation metric. How much is the market willing to pay, that premium on top of the book value of the IC? Now, investors may believe that the IC, the invested capital, can be put to work very efficiently. There's huge growth opportunities, and so they're willing to pay a premium, the market value of that IC, above the book value. And so the hype factor is measuring that. But when we take the ratio, we get the combination. To answer the question, does quality justify the hype? And so that's what the value creation yield is telling us. Does the quality justify the hype? And so if we get a 5% value creation yield, a 10%, a 15% value creation yield, we're saying the current price of that invested capital is generating 5, 10, 15% profit. And so it's a useful metric to compare apples to apples, other rates, other interest rates, for example, treasury yields. But at the end of the day, it's combining quality and value into a single number. Okay, so let's look at some examples here. So here we're doing a screener here using ValueGlance.com, looking at some large companies. So a few examples to keep in mind. So here we see Tesla, for example, 4% ROIC. This is based on last quarter's numbers. 11.6% hype factor, and so if we combine those, we get 0.3 value creation yield. So on the lower side, meaning the current value that investors are willing to pay for that invested capital is generating a relatively small yield in terms of the profits. Let's look at another example here, Oracle. So in fact, look at Oracle and Amazon. So different companies, different businesses, similar ROICs, hype factors slightly different, but both of them have 2.8% value creation yield. And so because this is a ratio, we can have very different values of ROIC and hype, but still have similar values of the value creation yield. For example, consider Apple. So here we see 67% ROIC, much higher than these other companies, but a much larger hype factor. And so this goes back to the question, does the quality justify the hype? If the ROIC is much higher in the numerator, but the hype factor is much higher in the denominator, we still end up with a similar yield around 3%. And so these are examples for large companies. We could see there's a range of ROICs, there's a range of hype factors, and then we end up with value creation yields here, at least for this 10 companies, between 0.3% up to 3.1% here for Microsoft. Again, these are the giants. They tend to have lower yields. But the point is that we can combine these two metrics to get one single number. So now let's look at it another way. So this is Google. And what we're looking at now are the two metrics over time, because the value creation yield is a snapshot. It's one number. It's a yield at the moment in time. But if we look at those long-term trends, we can tell a clearer story. And so this is Google. We're plotting the ROIC over here as a function of time on the horizontal axis. And we can see the ROIC is as a percentage on the vertical axis. The ROIC in blue here has been steady over the years, maybe dipped down a little bit, and lately has been increasing. So solid quality over the history of the company. But what about the hype factor? And so we see the hype factor here, 2006, starting off a little high, drop down, oscillates up and down. We could see in pink, this is the equilibrium hype we've talked about in the past, that long-term equilibrium. And we see the hype factor oscillating around that. And so by putting these two metrics together, we can get the value creation yield. So we're plotting this all with ValueGlance.com. We do the calculations for you. And you can see now this is the value creation yield itself for Google going back decades. And we could see it ranging here 2%, up to 6%, dipping back down, coming back up here, now 5%. And so we're looking over the long term by combining these two quality value metrics into the value creation yield. This is what it looks like over time. But at the end of the day, what do we care about? Returns. And so how does this actually translate into returns? So why is the value creation yield so powerful? Now we can take that same data from Google over time and plot it a different way. And so what we're looking at here is the value creation yield on the horizontal axis. So we see 0 up to 6%. And then on the vertical axis, now we're plotting the stock returns. And in particular, the 3-year annualized stock returns after each one of these points. So we pick a point with that value creation yield we saw before and then say, in the following 3 years, how did the stock actually do? And we see there's some outliers over here. But the main point that we want to highlight is this trend. So you can see the trend following this arrow here, that the higher the value creation yield, the higher the long-term stock returns. And in fact, for this particular example, we see when the value creation yield was above 4, the 3-year return was above 10%. Now that won't always hold in every case, but what matters here is that we're looking at data over the long term and seeing a clear trend. Higher value creation yields for the business, meaning you're getting the quality of the business at a great value, translates into higher long-term stock returns. And so we could see that clearly for Google. But this is just one example. And so you might say, well, this is a little anecdotal. How do we know that this metric really has the power? And so to do that, we need to do a full backtest. And so this is where we put the value creation yield strategy to the test. What we do here is go back in time, go back to 1990 and say, there's thousands of companies out there. Let's filter them according to this value creation yield. Let's find the highest value creation yield, the best quality for the best price. Create a portfolio of stocks, hold them, say quarterly, every quarter, and then you make this trade again and again and again until present day. How would your portfolio have actually performed through the ups and downs of the market? And that's what we want to see here. And so what we're looking at is starting off with $1 in 1990, two different strategies. One, the S&P 500 index, that's our benchmark. And we see over that time period, it returned 8.6% annualized. If we were reinvesting dividends, about 11%. So pretty good, sticking with the diversified market index. But what about our value creation yield strategy? And so what we did here was take a value creation yield, VY, greater than 15%. So pretty aggressive, high ROIC, low hype factor to satisfy this condition. So that's the key condition. We're also taking companies that are bigger than 50 million market cap, so say plus 50 million market cap, and we're excluding financials since they have more complicated financial data. So ignoring the banks, above 50 million to rule out companies where the data is less reliable, and then sticking with companies above 15% value creation yield. If we do that, going back to 1990, we see that this strategy turned $1 into $700. Okay, compare that with the S&P 500. We see $1 turned into about $20. Okay, so put that in perspective. If you're an investor in 1990, let's say you're 30 years old, you buy the S&P 500 and you retire with $200,000. Okay, fantastic. If you follow the value creation yield strategy, turn that $10,000 into over $7 million. And so it's a simple strategy. We're following one key metric, but by actually putting it to the test with thousands of companies, filtering them down, constructing portfolios, doing the full backtest, we see that through bull markets, bear markets, tech bubble, housing bubble, pandemic, all of the ups and downs, this strategy continued to perform well. Now we notice there's still dips along the way. That's part of the investing game. There's always going to be ups and downs. There's no perfect strategy, and you can modify these conditions. If you're interested, you could try valueglance.com, do your own back test, change it to 10%, 20%, play around with it. But the point is that we're using one key metric here that combines the quality and value through ROIC and hype factor that when tested over the long term crushes the market, right? 20% compared to 8.6% investing in the S&P 500. Now, no metric is perfect, but by looking at the long-term trends, by putting these strategies to the test, we can develop investing philosophies and strategies put to work that compound over the long run, that beat the market. There's no get rich quick here. We could see this is over 36 years, but it is a get rich eventually strategy. By compounding wealth over the long run, we're using the compounding power to our advantage. We see that $1 into $700 is very powerful the longer we wait by investing in high quality companies at non-bubble prices. So that's the value creation yield. Check out valueglance.com if you're interested in running your own backtest, looking at the value creation yield for your favorite stocks. And remember to invest for the long run and keep compounding knowledge.